Taking a look at futures, we are rising to start the week. Taking a look at yields right now. We actually have got a lot to watch because we've got inflation data coming out this week. Here's the 10-year. We're at 4.09%. That's a gain of 1.9 basis points. But still, that August jobs report did show unemployment hitting its highest level in 4 years. And investors are now betting on a quarter-point cut at the meeting next week. Some predicting maybe a half-a-point cut. Treasury Secretary Scott Bessent weighing in on the upcoming jobs revision. Watch this.
We're going to get the revisions for last year next week, and there may be as big as an 800,000 job downward revision. Again, this would be the second downward revision, so I'm not sure what these people who collect the data have been doing. The jobs that are being created are going to either native-born or legal Americans. Most of the jobs created under the Biden administration, they went to illegal aliens.
Bessent also saying the Fed's post-2008 gain-of-function policies have distorted markets and widened inequality, warning they threaten its independence, urging a return to its core mandate. So writes the Treasury Secretary in an op-ed in the Wall Street Journal. I want to bring in Ironsides Macroeconomic Managing Partner and Director of Research, Barry Knapp. Barry, good morning. So as you heard, we've got PPI Wednesday, CPI is Thursday. What do you expect?
Well, the street's at 0.3% for core and all items CPI. But I think it's important to step back and think about a couple things. One is we had 5 months of basically downside misses in inflation. Last month we had an inline number. The 6-month annualized rates of all of the measures, all item CPI, core CPI, rent of shelter, and non-housing services all have been falling over the last 6 months on that basis. The only part of the inflation dynamic that's been somewhat stable is goods prices, but they're running at 1%. And I think there's a couple things really that are important to keep in mind here. One is this mythology that inflation is always and everywhere only a monetary phenomenon. The big inflations we've had in this country after World War II, the 60s and 70s, and again in 2022, were all caused by fiscal policy. Theoretically, monetary policy could soak up the excess spending that the fiscal authorities do, but politically that's almost impossible. So the real issue has always been fiscal policy, and fiscal policy is now in reverse. It was running at a 45%, that's government spending, that is, was running at a 45% annualized rate in March of 2021, which basically took goods prices from 1% inflation to 12.5% inflation within about 4 months. That's now back down to a 6.4% growth rate, right at its 70-year median of 6.5%. So fiscal policy's in reverse. The conditions don't exist for inflation. Sure, we're getting changes in relative prices. We had 2.2s on core goods prices in a row. This is not an inflationary environment by any stretch. The monetary conditions aren't there either. So I think the Fed is really right to look through this. Waller is spot on this. And I'm, by the way, you said some are in the 25 camp or the 50 camp. I'm in the 50 camp.
There you go. We'll take it. I think we all, I'll take a 50. Kenny Polcari's on set. He's got a question for you.
Hey, Barry, how are you? I was just going to ask you that question about which camp are you in, but you already announced it. I'm actually also thinking that 50 is probably where he's going to be able to go as long as CPI, to your point, and PPI don't show any kind of, big misses in terms of, way outside the box of what we're expecting. I really think that 50 is a possibility, and I'd like to see that happen. And then potentially one more this year for a total of 75.
I actually think they need to get 100 done really quickly, Kenny. By the way, tomorrow's benchmark revision is a very big deal because it's also, although that's only through March, it's likely, given that trade-related uncertainty and the cuts in government spending, that monthly trend, and let's say Waller's number of minus 60 per month is correct, it's likely that's gotten that overestimation of small business employment, which I would trace to the Fed and the way that, and this is what Bessent was talking about, in his op-ed over the weekend, the way they eased primarily through their balance sheet and then tightened primarily using rate policy hurt small businesses. That's the core of the overestimation. So with a big negative number tomorrow and the probability that that overestimation of small business employment likely got worse, the imperative of cutting 100 basis points quickly to actually create an upward sloping yield curve is just tantamount here. That will reopen the small bank credit channel. That will lower financing costs for floating rate borrowers, i.e. small businesses, real estate developers. That could revive the housing market, tighten the spread of mortgages to treasuries, and really that's how we could get growth restarted at the fundamental base small business, individual level.
Yeah, talking about Q4, which is something that the Treasury Secretary has discussed. Liz Peeks on set. She's also got a question for you. Sir.
Yeah, I love everything you just had to say. I think that is exactly the bull case, and so good for you. Just a minor question. The governments of England, France, and Japan seem to be in total disarray. The market's completely ignoring the disruptions in Europe and so forth. What do you make of that? I mean, should we just pretend it's not happening?
Yeah, it does raise questions about the American exceptionalism trade and whether you should be pouring money into those markets. The markets got very excited when Germany ended the debt brake and decided to spend money. And I looked at it and I thought, well, the German 500 billion euros of spending kind of looks like Biden type, industrial policy, 100 billion on green energy and so on and so forth. So yeah, I kind of rode that trade a little bit, but I wouldn't, go too all in on all that. They have serious fiscal problems. Fortunately here, the concerns about fiscal policy have really been tamped down in the U.S. Treasury market. So when you look at things like the term premium of long-term treasuries, 30-year swap spreads, all these indications of supply that were really under pressure in the fourth quarter of 23 and 24, those are really quiet right now. So the market's really not worried about U.S. supply any longer. But, yes, we have to keep our eye on this for sure. It is, on balance, lifting global bond yields, putting upward pressure on it. But, again, piling into those equity markets, given those structural problems they have, I don't know. I still think you should have the bulk of your assets in the U.S.
Yeah, no, and I'm glad that Liz brought that up because Europe is just to put a fine point on a bit of a mess right now. Barry Knapp, it's great to see you. Thank you so much for being here.